Good morning, 0600 a.m. Pacific Standard Time, date 5/19/2011. New York Stock Exchange, we have a gap. We like Caterpillar. We'll be trading Caterpillar off of the bottom today. Caterpillar hit 101.75 yesterday. It has a lower volatility trade, and then it likes to move off that bottom, and you usually can pull a good $1.25 out of it from the bottom back up to the high. Now, from selling short up at the high, you're generally going to get, 70 cents pullback. Caterpillar, Cummings, CMI, we'll have Mr. Mantalk watching this one. We'll have people watching the Caterpillar trade. So when Caterpillar drops down to that teeny line in your platform and it gets that buy action bar, because of the ranges, you want to get triggered in right away, because you don't want to give up 70 cents of your profit spread by the time you want to get in it. No, that's not how it works. How it works is you get the lower end so that your entry is below the market when it's trading above the market. We've had a lot of selling for the last couple of weeks. Hess has been sold down. We like it. We like Cummings. Caterpillar, we really like. Institutional money is always here. They got good earnings. They got good yield. They got dividend. That's what they like. So basically in the NYSE, black BLK is up 3.75, and it is an options expiration. Today's Thursday. So we've had the bull reversal. This is the third week. We've had a counter trend. We came down and made lower lows. Now we're in another bull counter trend to that reversal that we talked about 3 weeks ago and pointed out. So each time they get this counter trend, they've got the volatility. What took these markets down were a lot of the commodity stocks due to margin requirements. And margin requirements were part of that selling in that commodity space. The silvers and the precious metals and some of the oil services, things of this nature. Now that that's starting to play itself out from its bull rally reversal down to price support levels, is cherry picking the leading companies. Caterpillar is one. So this is the gap up list. CRM is another one we like to trade, but that's going to be a little bit more volatile. I suggest that we stick with watching the Caterpillar and the Cummings, CMI. If they're lower risk entry trades and less emotional to be in. Now, that's for that. And we are going to see if the same stocks, where the money is always going to come in Caterpillar now. And Caterpillar was on our overbought list. It was a short for a couple of weeks. It's come down to levels right above there in that $101 range area in its pullback, and then it's had its bounces. So when you take a $1.08 gap, what you'll do is you'll put the limit order down there below the market, and you'll put that limit order down there at 104.75. The closing price on Caterpillar was 105.25. The gap price right now is 106.35. So when they drop that bid down there, and if they walk away, and if that limit order is out there, you get hit. And once you do get hit, you get that great little bounce, and it's off to the races, and you're selling for a profit. So options volatility gap in the NYSE with good quality names and their first bull rally pullback phases. On the gap open down list, we've got AAP down 5.66. We got BIG down, BKE down, GameStop down. So the gap down list is not huge. These are all just little penny gaps down. So between the two is we have a pretty mixed bag. We've got a slightly better gap up. So when stock trends pull back from bull rallies, they have another phase where new money comes in. Watch FCX today. Watch that drop down bid on that FCX. They're low beta stocks. The volatility is not as horrendous as it is in the Googles and the Apples and the Sohos, the SINAs, and other areas like Amazon and whatnot. So reducing volatility with the true directional price range is easy entries and exits with less emotion. So basically, we will see how these things fare. We'll be watching, we'll be scalping various different leadership trades that the bigger money is going to be going into on the first bull rally pullback, where new bull money comes in and they find them attractive.